say make money, money, make money, money, money.
Make money, money, make money, money, money. Money makes the world go round. I'm not talking around town.
I just want to remind everybody before we start here, the information provided on this podcast is for general informational purposes only and is not intended to be financial advice. It is just our opinions. You should consult with a qualified financial advisor before making any financial decisions. With that, let's move on. Welcome in to Just the Tips podcast by the Stock Jocks. You've got your two favorite jocks here today. We seem to be missing one. Bruce, who are we missing?
I think we're missing Gordo.
The large one?
He flew the coop.
Flew the coop. Where'd he go?
I don't know. Back to his Mexican hideaway.
I thought maybe one of his ex-wives got him.
It was one of his ex-wives or one of his future wives. But it was definitely one of them.
Future sounds better than ex. That's all I'll say. I've had to be kidnapped. The types of activities one might perform as an ex versus a future would be quite different.
That's true. That's very true. But in any case, I think he's on a somewhat temporary to permanent sabbatical. We'll have to see how everything unfolds. But
yes,
I think it's just down to the two of us for this episode at least.
Well, we're still jocks plural. There's still two. So for this episode, I thought maybe given we haven't been here for a while and and so many of our last picks are, as the kids would say, fire, we do a little review. Normally we do this when we hit 10 names. We're going to do it with 6 names, go through them, look back at the performance, see how they've done.
Is it
and on
6 or 7 names?
I think it's 6. Did I put 7 in?
No, you're just talking about the kids, so I figured I'd drop a 6-7 reference.
Oh, you got me with that one.
Our viewership can be very young these days. You never know. Kids get started early trying to pick stocks.
You know, my son's in middle school, and he is president of the investment club, and his co-host heard I had a podcast, and so he was asking me about it, and he's like, "What's the name of it?" And I'm like, it's just the tips."
I'm sure that went over well. You were either like the coolest dad in school, or all the other parents are like, "Don't talk to that family ever again."
You're not allowed to hang out with them. I'm going the latter. Well, on this podcast, if you're new and you're joining us, what we typically do is we take a name and we'll debate both the bull and the bear side, and then at the end we'll reveal our true positions. As I mentioned, this is a look back episode, so we're going to do it a little differently, and we're going to look at how our recommendations have performed. But before we do that, maybe we should hit some recent happenings in the market, aka the news section.
Yeah. Yeah, I think
you can't cut off the news. News alert. Is that what it's called? An alert.
I forgot about the news jingle. It was a good one. It needs maybe a little workshopping, but we'll take what we can get at this point. Yeah. So maybe we want to start off with the round of AI news that came out from every single direction over the past couple months. The most notable was obviously the hyperscalers who are continuing to perform, I would say, and then also, they've also added another weapon to their arsenal, which is to create headlines, which are so gigantic in nature that they end up moving the stocks and moving the market, and it's been, kind of amazing to watch. I'd say maybe the biggest culprit here is a private company who's effectively, performed a private IPO at a $500 billion valuation, but nonetheless still a private company who is, I think, committed to $1.4 trillion in data center commitments, and they're anywhere between 14 and 20 billion of ARR, run rate ARR. They're definitely not 13 billion in ARR. So don't ever put their don't ever sully their name with such a such a soft number. So yeah, I mean,
If you
we
think they're
learned
that low, you can sell me their shares.
that's right. Yeah, I think we learned
Got
on
plenty of
BG2.
buyers.
Yeah, that you can't really ask a pretty straightforward question without getting berated by people from the OpenAI side. Um,
Just for reference, for those who may not have heard it on the BG2 podcast, the Altimeter co-founder Bill Gershner. Am I butchering his name there?
Brad Gerstner.
Brad, I something fell off. Sorry, Brad. Brad Gershner was interviewing Sam Altman of OpenAI and Satya of Microsoft, and he was asking this exact question. And so Sam had a very terse response where he
Pointed.
said,
Yeah.
he said, "How are you going to afford this if you have only 13 billion in ARR and you have trillions of dollars going out the door?" And he said, "Well, we're higher than 13 trillion or 13 billion."
How dare you ask us about 100x commitment on our current ARR? How dare you? Like, it was
I'm
an amazing exchange, and it made the rounds everywhere. I think it seemed like a pretty straightforward question, and actually, the way that Brad had phrased it, he said it was the question that came up the most from I think their own audience in terms of like what they wanted to understand from a pretty high profile interview. So I thought it was totally fair play. I thought the answer was a little more pointed than it needed to be, and maybe it was one of those things where if you get asked that question too many times, you end up it ends up creating a little friction. But nonetheless, I think the point still remains. I don't think we have a good answer to it. That there's just a lot of outlay here that OpenAI and others have committed to, and the revenue hasn't showed up yet, and the balance sheet certainly hasn't showed up yet. And I know a lot of these companies on the hyperscaler side are very profitable, obviously, so they can fund some of that, with their own profits, and they obviously have access to the debt markets and the equity markets and every other market that you would want to get capital from. The same is
Which
true of
they're tapping.
OpenAI, but the magnitude here of commitments is just, like way out of sync with what you would expect a company at that scale to, go out on a limb and commit to. So there is a little bit of dissonance, I would say, between the numbers that people are hearing and reporting and like where these companies are. You really have to believe that AI is going to show up in a very, very big way in like the next 5 years, which I think we all do. We just don't know what the magnitude would look like.
Yeah, and the problem is, I mean, the bigger problem is you've seen the stock market, as you alluded to up front, just react, right? It's like, it started kind of with Oracle, right? Oracle was talking about and they didn't name OpenAI, but they said, "Oh, we've got all these, commitments for data center, RPO dollars." Their stock went insane, and then it was just a domino. It was company after company of that OpenAI had made a commitment to, and then Nvidia was getting the act as well, in terms of investing in or taking interest in. But the problem is if they can't make these commitments, all the stuff that's been built up, right? Like all the stock market value that's accreted to the spend that may not happen is going to come crashing down.
Yeah. So I mean, we'll see. It doesn't seem like the market has seemed to care. Maybe in part driven by the fact that a lot of the hyperscalers who have reported, which I think is most of them, if not all of them, have really, really outperformed. I mean, they are seeing real scale gains here. Not only beating their targets, but updating their guidance for the year, and they're doing this at massive, massive scale. And so, I think while there's been sort of maybe a little bit of feast or famine for the companies, like if you look at them as a group over the last year, obviously the Mag 7 has massively outperformed the rest of the S&P, and a lot of the gains in the S&P are driven by the Mag 7 versus the S&P 493. But I think as it relates to this latest earnings report, Meta was probably one of the couple companies that took a little bit of a misstep, and I think like from my standpoint, a little bit of the the dissonance in my mind is like they absolutely crushed their numbers. I think I want to say they beat top line by like $1 or $2 billion at scale. They made some massive commitments on the CapEx side, which I think is like starting to ring a little bit true to our earlier discussion with some investors, just because Meta versus Amazon or Microsoft, they don't have the same modality into the market. Like they don't talk to enterprise buyers and enterprise customers in the same way. They haven't built a large scale cloud offering and cloud business for the last 10 to 15 years. And so people are sort of wondering, maybe like scratching their heads and trying to figure out how are they exactly going to monetize all of this spend. I don't think they've really articulated it either, which is, given, I think, some, it has raised some doubts and some questions and obviously some risk as people think about it. It feels like in some ways they're using it, to optimize their ad platform in a very, very, adept way, and that's been able to produce outsized returns for them in their core business. It is a little bit of a question mark, especially given their commitment to open source, how they're going to monetize that outside of sort of their core business. But they're one of the few companies that has access to data, access to capital, access to chips, and access to power in a way that can help them build a large language model that other people can't.
Yeah, no, absolutely. I asked OpenAI here, just to pull it in, like the CapEx trends for some of these big companies. So, for example, Meta did, let's see, in 24 it spent about almost 40 billion, 39 billion of actual CapEx, and then 25 their guide started out at 60 to 65, then went to 64 to 72, and now is at 70 to 72. So like you can just see the magnitude of that growth. I mean, went from 39 now up to 72. That's almost, a double in CapEx. And it's been that way across the hyperscalers. And you look at them all. But yeah, Meta's the only one that had that kind of reaction. I think,
Yeah.
as you said, it's a little less clear, right, what they're doing with those dollars. And there's been some reports of frustration, right, in their AI group where they're spending tons of money on personnel, like they're not getting the results they want.
Yeah. Well, Zuckerberg made that comment at the Trump dinner, right? When he asked him like how much you're going to spend on data centers, he was like, well, at least like, I don't know, like $600 billion. It like became a meme for everyone, like, talking about how much they're going to spend on golf or how much their wives are going to spend at the store kind of thing. But it is one of those things that's like more of a, like a broader statement around how many dollars are going into this ecosystem. And we're going to talk about one of the recipients of those dollars a little bit later on. One of our calls was a neo cloud data center company, so we will talk about that later. But nonetheless, a lot of money going in. We gotta yet to see as much coming out.
Yeah, I mean, I will say it's one thing that's interesting, and we didn't chat about this, but I'll throw it out here now, is I had one of those aha moments with AI this like past week where I was talking with a founder who showed me how he was rebuilding a very popular piece of software with 4 laptops. And basically, he's like, before, yeah, vibe coding didn't really work. It would always break. He's like, the models that came out in the last year or last month are completely game changers. And so he's taking like a very well-known piece of software, rewriting the whole thing to be much more efficient and better. And he's done that. He hasn't put it in production yet, but this was something that took thousands and millions of engineering hours, and he's doing it with 4 laptops. And so he's like, this was not possible until the last month. And so I think we're going to start to see if he's right, and what he was showing me was like mind-blowing what he was doing. I think you're going to see the pace of like software development just accelerate. And I think we might be surprised what comes out of some of these large hyperscalers. Like everything is in play now. Like software truly becomes a commodity if that's the case, right? You can write any piece of software with a couple of coding agents going full time. You have to know what you're doing. Like he's like, every once in a while I get stuck. I have to go in there. But like for the most part, if you know what you're doing, like, and that's why they're willing to pay big bucks for the best folks, because they're the ones that can do this. So I think you're going to see some mind-blowing stuff coming, in the next month or two.
Yeah. The issue is, I think the technology is getting really good really quickly, but it's like it becomes commoditized too in the same way. And so like, is there like a sustainable moat, or is it really just a race to the bottom? Like with every successive generation of the technology,
Yeah.
if you have 5 different companies who can afford to lose money and push that technology, like, do you have a sustainable moat? And if it becomes open source, like, was there ever a moat at all? And so I think it is getting like much better, much quicker than anything we've seen before. I just wonder, like, if you can use that to, sustain a real operating, moat as it relates to acquiring customers or keeping customers or the lifetime value of customers or preventing churn or focusing on NDR or doing all the things that we saw in the previous generation of enterprise applications.
Yeah, 100%. If that's your baby's mama, you need to take it. Let me know.
It was an 800 number, so it could be, is the short answer. um, but I think it might be just one of those robo spam numbers that your friend's vibe coding put together and is calling me from some other zip code.
Exactly. AI at work and real life applications.
That's
Um,
right.
all right. Should we jump into the performance, the main
Yep.
event? Let's get
Let's
ready
jump
to
in.
rumble.
We're probably going to need to speed through some of these. So if you guys have any questions, just look at the results. You're welcome.
All right. Let's see. All right. So where are they now? Part 3. So let me see. Can you see my screen? I'm gonna put this in slideshow mode. I have switched to a Mac, so I am like a fish out of water here, as I've always been a PC guy having to deal with spreadsheets. So there's 6 names we've covered, not 6, 7, just 6, just 6. We've got SoftBank, which I misspelled to Soft Tank there. WLDN, Samsara, Circle, NBIS, and Uber. And so if you go down their absolute performance, as a team here, we've absolutely crushed it. So Stock Jocks, we were long SoftBank, that is up 40% overall. And then if you look at it, we also look at it versus the S&P 500. So if the S&P 500 during that same time, in this example, rose 4%, we outperformed the market by 36%. So it's relative to that. So as you see the slide, SoftBank relative performance was up 36%. As a group, we were short on WLDN, and that went down 20%, while the market went up 4%. So relative performance is positive 24 for us. On Samsara, it basically did what the market did. It was up 8%. The market was up 8%. We were long that, so it's basically a neutral. Circle, this one, again, we nailed. It was down 45%, while the market was up 7%, so we outperformed by 52%. And then your baby, Bruce, NBIS, this was a great call, long. All 3 of us were long. It was up 115% relative to the market, which was also up. It was 106% outperformance. And then finally, Uber. We were, as a group, selling Uber. It was up 5%, and it had been one of the best performing stocks of the year at that point, back in late May. However, the market really ripped since that point. I think we were still kind of in some of the tariff doldrums, and the market went up 16% while it went up 5%, so we outperformed by 11%. So if you look on just an absolute basis, our average return was 37%, and then on a relative basis, we were outperforming the market by 38%. So I would say that is outstanding performance. These aren't even, a full year hasn't gone by to get these kind of returns. Like, I think any investor would be jumping up and down. So job well done to us. Any commentary there on the performance? So again, strong performance. I think we all perform well. I don't want to say I beat you, Bruce, but I beat you.
This was just based on one call, and like I still think that I'm right. We'll talk about it later, but WLDN just reported, so
yeah. I've got valuations here. Maybe we can flip back and forth to those. I think as a slide by itself of the names that we're going to talk about, not interesting to compare to each other because they're all different. But maybe we jump into the first one. We'll go through these and kind of give our updated views on them. So again, SoftBank. This is we're looking at the Japanese ticker 9984. We covered this on September 5th, so it was the last name we covered. In that time, it's gone up 40%. Well, the S&P 500 only went up 4%. So again, strong outperformance of 36%. All three stock jocks were a buy. So the question now is, well, what has caused this, and do we still think it's a buy, a hold, a sell? How would we react to it? And so I think the big thing that's really probably driven more value here than anything else, again, this is like a holding company. It has big positions really in ARM Holdings, which is a public stock. They own about 90% of that. You can go look at it. It's very observable value. The ones that are less observable are really OpenAI, their OpenAI position. They will have roughly, when they complete their investment, call it 11 to 12%, not 6, 7. And the Vision Fund is another big piece there, as well as some other holdings. So OpenAI, I think, is really what's kind of driven this stock. When we first started talking about it, I think they were valued at $300 billion. Then there was a sale done in the private markets at $500 billion. And so that value has been pushed up, and people are I think in their own mind have their own valuations on this number. So that's where I would say, or speculate, where a lot of the strength has come from in this name. I went through and updated my kind of sum of the parts valuation, as that's how we looked at this last time. That's how I continue to look at it. They've since reported some updated numbers. And so the numbers that I derive using the $500 billion OpenAI, which is the biggest change. I did update ARM's price and all the other price of the publicly traded names, as well as the reporting values on the other assets. And I get a NAV per share of almost 26,000 yen. What you see in the stock price today is 21,700. So that's a 16% discount. And then what we did when we looked at this is we said, well, what if you thought, OpenAI was just a generational company and it was worth $4 trillion. And so took a different view there. I redid that calculation as well. We also took a bullish position on ARM, took the highest price target that any analyst had out there, which is almost double from where it sits today. Gave the Vision Fund a 2x return. And then, so what's the value, your most bullish scenario? That got me to 58,000, which is a 63% discount. If you look at this historically as a holding company, it's tended to trade at a discount to its NAV. Anywhere from call it 30 to 50%, most of the time being closer to 50%. So while I think about it, I'm excited about OpenAI. I do feel like there's a lot of hype right now. I would tend to sit on the sideline on this one because I just feel like that upside, that discount of everything going right isn't big enough to get me excited to put my capital at risk in the same way. So I don't know, Bruce, if you have a different take on this one.
Yeah, I have a slightly different take. I mean, I think it's one of those things where everybody should have access to OpenAI, and this is really the only way to do it. It does come with a lot of other balls and chains, but it is one of those things I think where over time, a lot of the value here will be driven by OpenAI and to a large extent AMD, who I also think is seeing tailwinds, although I think their last quarter they were a little bit soft, and so stock got punished, and because SoftBank is such a large holder, their stock also retraced a little bit. But I do think if you're you believe in AI, which you probably do if you're listening to this podcast, you should have exposure to OpenAI, and this is literally the only way that you can get it. And so, I think that this will continue to perform. And I think over time, if OpenAI does go public, you'll see a meaningful step up here in value.
Yeah, I mean, right now, per my calculations here, it's about 9% of current NAV at the $500 billion valuation. So it's not a huge driver by itself necessarily of overall SoftBank. So hopefully you can get exposure, but is it a pure investment? No, it's at 9% of the NAV. They've talked about going public at $1 trillion, so maybe you get it. If holding everything else equal, maybe you get it up to, high teens. But it's not a majority of the stock. The majority of the stock is ARM and other holdings.
Yeah, I think that's true, but I do think like one, they're going to monetize ARM over time, and I think ARM is like reasonably good investment to be a majority holder of. And then two, I think like 1 trillion is probably like your base case, maybe your low side case. There's a real possibility that OpenAI trades at like one and a half, $2 billion or 2 trillion, sorry, dollars, and if they execute on their plan, right, which is somewhat unknown, but also has been reported on, and they get to 200 billion of ARR, then you're looking at a like $500 trillion company, right? Or $5 trillion company.
Well, with 14 billion in revenues, that's a very reasonable multiple.
You got to believe the hype, man. You got to believe the growth.
100%. All right, next one, Wilden Group. All right, so this is one where I think again we might disagree. After all this agreement up front, I feel like we're going to disagree, but I'll cover this one as well. I think I was the bear on this one originally. So Bruce, you were the long. I think you had a long position in your own portfolio at the time. Me and multiple Gordos, were sell. The performance was absolute performance. It was down 20%. Well, the market went up 4%. So we said relative underperformance of 24% there. The big issue before they reported a quarter, so I kind of highlighted some of the quarter here. Like they've continued to on the same trajectory that we've been seeing, I think, for most of the year. So, net revenue, which I pay more attention to than contracted revenue, is up 25%. Net income up 87%. Adjusted EBITDA up, 52% year over year. So very strong numbers. It still tends to be, if I go back to the valuation slide, which I said we would reference. So it is, let's see here, Wilden Group. If you look at it, it trades at 16 times forward EBITDA and almost 28 times forward PE. It's less than a rule of 40 company. People are expecting 18% growth next year. It's a services business, which was always the challenge. So services it does not scale like a software company. You constantly have to add heads. It's hard to really get margin expansion in the same way. And so I don't think here you see those businesses tend to trade at low, even single digit multiples. And so this thing, even though it's come down and they continue to perform, it still doesn't feel cheap maybe in the same way. But I'm more neutral on it at this valuation than before, which was even higher, right? And they've continued to show performance. But
Yeah, I mean, my view is this company is in the right place at the right time, and there's going to be another decade of electrical load growth, and they're well positioned to take advantage of that. And they're beating their numbers across the board by massive amounts, right? Both on a percentage basis and an absolute basis. Like they're beating their revenue numbers, their EBITDA numbers, their EPS numbers, and they're raising their guidance for the year. Like this is a company that's seeing real momentum in their core segments of the market, and I don't expect that to like decel in the near term. It depends. Like it looks expensive if you consider maybe the lagging indicators, but very few companies have 52% EBITDA growth year over year, and so and very few companies are beating at EPS. The street's estimate for EPS was 365, and they came in at 410 to 420. And so it's like these guys are handedly beating the street. Like these aren't small beats. Like they are clearly seeing something in their end markets that they've never seen before. And so, I think in the short term I was wrong. I do think like services plays a factor here. I think like the size of the company also plays a factor. Like this just isn't going to hit the radars of a lot of institutional buyers. It's way too small.
There's like no research coverage from what I could see.
Yeah, there's almost no research coverage. I think Wedbush covers them, but like this is like an under the radar company that I think is going to continue to execute and perform. It just won't have some of the tailwinds like everybody's an investor in Nvidia and Facebook and Google because like they have such massive floats and everybody can invest and get in and out with relative ease. This is like a $1.2 billion company. It's not going to hit the radars of a lot of institutional capital. So I think there's, it's one of those like you have to believe in, sort of the we found a diamond in the rough thesis here that like over time, the market will realize it. And as you hit, more and more, kind of gates, then the valuation will expand. And then it will start to like if the company was able to perform and it hits 2 billion and 3 billion, then you do start to register on the radars of institutional capital and you will have people start to invest and, the stock itself will become more liquid. So you do have to believe in the longer term story. But I think like this isn't something that you can just turn on overnight, even the services component and even just being able to get into some of these contracts. So I think it's a reasonably good company if you want to kind of set it and forget it for a couple years and, continue to get exposure to a part of the market that other people may not. It's obviously going to be a higher beta name, but I think it has a lot of potential and, the team has executed really well.
All right, so you're still a buy. I would put myself more in a hold camp, though we don't usually try to go hold. But the one last thing I'll comment on is so if you look at their net income, they get propped up by they've had negative tax rates because of some of the work that they do. So they're actually getting money back from the federal government. I think that ends after this year, so that's going to be a big impact. They're going to go to paying normal profitability tax rates. So it's going to be a big, like 30% plus tax swing for these guys next year. So that is a hit to the cash flow that they generate. But let's keep moving on. Samsara, you want to cover this one?
Yeah. So, Samsara continues to perform well. I think since we reported on the podcast, they've been relatively flat. It looks like they've performed in line with the market. So George and me were both buys, and then Gordon was a sell. And so, it's kind of been a sideways tape, I would say, for them. I think the read through, though, from my perspective, is this is a company that is also somewhat, I would say, misunderstood. It's in the segment of the market that isn't as well covered as maybe some of the sexier AI parts of the market. If you do read through their earnings, though, and listen to their call, the company is seeing real momentum and real traction in their business. Big deals are accelerating. I think they signed the most number of $1 million plus ARR deals in the quarter, plus 17, which is a record for the company. They're seeing healthy international expansion. It was 15% of their new ACV. They have elite, net dollar retention or net revenue retention at 115%. Revenue was above consensus. Revenue was also above, what their beats have been through the average of the year. And so, I think they're continuing to see strength here in the second half of the year. And net new ARR came in, above, their prior quarter as well at plus 19% versus, 5% in the prior quarter. So I think at the end of the day, this is a company that's in a very big market where they are I think the most dominant player, but even more so, the CEO, as we mentioned in the actual podcast on the name, is a real compounder. This is somebody that you can bet on. If you look at the tape here for Samsara, going back to even when they were a private company, he's continued to be able to deliver and develop and accrue value for this name. And so, again, this is a segment of the market where you have basically the number one company who's continuing to perform. Market, is still maybe hesitant to over reward, companies that aren't, talking about $1.4 trillion data center expansion commitments. And so it is one of those names that kind of flies a little bit under the radar. And so I wouldn't expect like the beta here to be maybe as high as a WLDN or somebody else. But it is one of those names that I think will, continue to generate a lot of value. And you're betting on a proven, a proven management team with, a real execution track record.
And I would say, it's we call the performance flat because the S&P went up 8%. But if you can earn 8% in what is it, 3 months in a quarter, like I would take that all day long. It's
Right.
not a bad outcome by any means. Um, yeah, and I echo that, and I think for those who are not, we didn't really kind of talk about what they do again to rehash everything, but they're really their ticker's IoT, which is Internet of Things, and they help track trucking fleets as an
Please,
example,
yeah.
telematics on those. That's kind of their market. It's not a cheap stock, so if you look at it, I mean, I wouldn't pay too much attention to profitability. I don't think they're trying to drive that, but it's 12 times forward revs. So it's not super cheap, but it is one of the better growers in the market today. Like if you look for growth, they're expected to do 26% in the next year. Rule of 40 company at 46%. They're valuing the growth. So to me, like, combined, I actually bought a little bit of it myself. I'll call it a small position when it dipped right after we covered it down here. So I continue to be a buy on it and a holder. So I agree with you there. All right, next up is Circle Internet Group.
Circle.
This was a interesting one when we covered it. I think it was right at its top of its hype cycle. I felt like it was going to the moon.
Yes, and I think we were all right on its performance. We were all sells on the name, and since I want to say since we reported it's down very substantially. I think it looks like it's down 45%, although it says app, but I'm not sure. It might be a typo.
Ignore the ticker here. We're gonna have
Yeah,
to fire this analyst.
um,
Be
but
me.
nonetheless, I think this is one of those hype stocks where somebody from a Reddit forum or something got very excited about the prospect of what Circle was doing, which I can empathize with. I'm very much a crypto bull, and I think that Circle is as it relates to stable coins, maybe the best, but at least the second best product in the market today. It's partly owned and sponsored by Coinbase, and it's in terms of its total value in the market. I'm maybe making this up, but I think it's the second biggest stable coin behind Tether, and so I think it is one of those companies, especially in the Trump administration, where crypto has gotten the green light, that will continue to benefit right from the tailwinds just from a regulatory standpoint. But the valuation here, I think, raced way, way ahead of where the company is and where the company will be. Like, I would say if you bet on a company like Circle, you're not just betting on the business itself, which I think is also challenging, and I'll go into in a second, but you're also betting on the interest rate environment,
Yes.
which I think is very, very hard to underwrite. And the interest rate environment, if anything, right now, is one that's we're going to see more cuts than raises, and a cut in interest rates will really hurt this company's interest income, and so it's one of those things I think
Which
where
is their whole where they get all their revenue from is just holding treasuries essentially.
right,
So they're very rate
yeah,
sensitive.
yeah, and so you're making like this really multi-dimensional bet that's like they can't control, you can't control, and so I just feel like you're stacking risks, and like every bet on every company is you're making a bet on multiple things: the management team, the product, the competition, everything. But this is truly something where it's really hard to underwrite because we are in an environment where interest rates should come down, which should negatively impact their revenue. The other piece is this market has gotten way, way more competitive. And
Yes.
really, what other stable coins think of when they see Circle and when they see Tether is, the margin that they're keeping, which these new companies are willing to give up.
Yep.
And so effectively, they're saying, hey, we won't keep all this interest income. We'll give it back to you as, the borrower or the person using the currency. And so, it's like that old Bezos saying where like your margin is my opportunity. I'm butchering it a little bit, but that's effectively like what the next generation of stable coins has come out with and stated pretty publicly. And so I think you'll see that begin to impact their business as well. So it like goes back to like, do you have a moat and what are you actually betting on? And I think like the broader environment from a regulatory standpoint is very, very good for the company, but it's very, very good for everyone. And I don't know if they can continue to sustain either these margins, and they certainly can't really change the the direction of kind of the interest rate environment. So I continue to be a sell here.
Yeah, I mean, I think that was the bear case we argued at the time. It was interest rates and it was competition. I mean, you have everyone from like Walmart to JP Morgan, very credible issuers coming out and, competing with them. And then from a valuation standpoint now, just taking a look here, so Circle trades at 8 times forward revenue, 43 times forward EBITDA. So it's still not cheap. It's growing like a weed, but yeah, I think your bet has to be that volume growth just outpaces any interest rate cuts. It seemed like they're at least on the near-term horizon here. And maybe it's a bet that works, maybe not. But I think with the coming competition, I'm also going to be on the sideline on that one. All right. One more for you, Brucey. Your gem, NBIS.
Yes. This was a real winner, I think, across the board.
Winner, chicken dinner.
Winner, chicken dinner. I think, we were right on the thesis, right on the management team, and then we got lucky with some, fortuitous news here as well. And so when you're both right and lucky, then you end up, creating real outperformance. And so this was a great outcome. I actually did buy the stock when it had dipped down to around 20. And I've been offloading ever since it got past 100. So it's one of those names, I think, where, similar or in the same vein as what we talked about earlier, it's been a real beneficiary from hyperscalers making massive commitments to neoclouds and data centers. This is a company that has basically built a neocloud, so you can go and you can, rent Blackwells or GPUs, and you can use them on a kind of on-demand basis. And that's been a real constraint, obviously, for building the largest large language models and also allowing for enterprises to use them pretty flexibly. Going back to like a theme, I would say it's true of most of the investments that I like. This company is led by a real compounder. The CEO of the company built a company called Yandex before, we talked about in the podcast, which was a $30 billion company before Russia invaded Ukraine, and it was the Google of Russia. And so this, his name's Arkady. He knows how to build companies, and he was the CEO and founder of that company for over 20 years, I think. And he took some of the assets from that company, including a data center, and built NBIS. They raised a large financing round in which NVIDIA participated earlier this year, and they didn't relist, but they restarted trading under a new name, and it was uncovered at the time, by Wall Street, and it was uncovered by a lot of investors just because it was sort of an unorthodox way to kind of regain access to the market. But they have a couple of the key things you need, I think, to build an interesting neocloud, which is access to chips. Obviously, NVIDIA is an investor. They have access to power, so I think one of their biggest data centers in the Nordics. They have access to customers, and so the big kind of jump here was a reported deal with Microsoft through 2031 that would accrue $17.4 billion, and I think it can go all the way up to $19 billion over the next 5-ish years. And so massive commitment from Microsoft really kind of establishes a new base case for the company in terms of the type of revenue that they'll see. That was also enhanced by the fact that when they reported their ARR, they guided above what the Wall Street estimates were, what the consensus estimates were. They narrowed the range and they increased it for the fiscal year ARR for 2025, and then they announced this massive deal with Microsoft. So really, just seeing a ton of strength across the board. And again, this is an operator, who knows how to execute. They also, just as kind of a footnote here, they do have a collection of assets that they sort of bought out of Yandex. All of those assets have really performed. And so it's one of those things, I think, where even the sum of the parts looks better than it did when we first, podcasted on this name. And I think it will continue to get stronger, over the foreseeable future. which is the big question in my mind. In order to buy this stock at this valuation and at this level, you really have to believe not 26, but like 27, 28, 29, which means that they have to see a lot of this demand materialize, right? And so there's clearly risk to it, which is why I've been offloading at this level. They're actually reporting tomorrow, so we're recording this podcast on November 10th, and they're going to report tomorrow morning. Actually, I think before the market opens. So we'll see, what the latest and greatest are. But I do think it's not even about the next kind of couple quarterly reports. It's really about believing that this company will execute and see appetite in the next 5 years, which is, a really big bet to take, especially in a market that's this nascent. And you will have things happen, like the Chinese came out with DeepSeek came out with a model that basically showed that you didn't need all this data center commitment to get a compelling model, and then things like that I think will continue to happen over the next several years. So you have to be able, I think, to stomach the ebbs and flows of this market. But as it relates to kind of this whole generation of neoclouds, and there's like 10 of them, a lot of them have been repurposed from Bitcoin mining into data centers.
Yep.
This, in my opinion, is one of the highest quality names of those companies, just given the management team and the collection of assets that they have, the relationships that they have, and their ability to execute today. So I'm still a buy, but I'm very cautious on valuation.
Yeah, I would echo that. And just to look at the valuation, NBIS trades at a cool 26 times forward revenue. And again, I wouldn't look too much at profitability. 138 times EBITDA. So it's not a small number. They're still very much growing into it, but they're expected to grow like 400% next year. So obviously that growth is going to help power bringing those into line. But I've been on the same boat you have. I dumped some at 120 and 130. I didn't get in mostly at the 20s. It was more 30s and 40s for me. But yeah, it's been a great ride. I think I will opportunistically continue to play this name as I see those kind of dips and volatility that sits there. All right, last one is Uber Technologies. So Uber was one where Gordo and I were sells. Bruce was a near-term buy. At the time, I remember this was one of the top performing stocks when we covered it for the year. Really, I would say, they had a strong Q3 and reiterated kind of their next year targets for folks. And so like they've continued to perform well in both their divisions, both the ride hailing as well as kind of Uber Eats. They've been able to drive more from their existing base, and so they have a subscription program that's increased kind of the number of trips and the velocity of rides or the amount of rides that their average user takes. And then they're actively trying to address the AV, autonomous vehicle threat to them. So they've been doing more partnerships. They have a partnership with NVIDIA where they're going to be rolling out some of their own fleet. They continue to partner with different providers like even Waymo in certain markets. And so that's really kind of, where they find themselves. So they're trying to attack that. They continue to be an execution machine. I think, Bruce, I remember on the episode you were, to the common of compounders, like you're a big fan of Dara. I think Dara is an excellent CEO. We've seen him create value before at Expedia. He's done a nice job with Uber since taking over for the founder. But I think there are still a lot of just bearish headwinds, coming their way. And so, they did comment that like the AVs, the markets they're in for AVs are loss making. And I think there's some debate too of like, does AVs take share completely? Does it actually expand the market? So some people, and I can relate to this, I have on both sides, I have a elderly mother doesn't like to take Ubers because she's scared of the service of having a human driver. And then I have kids who I'm also not, a fan of. I'd love to be able to throw them in a Waymo and have them get to their events and me not having to take them. So I do think it does expand the market. I just have a hard time really wrapping my arms around like, can they really be the ones to own this? As I think about like, what are the hard parts of that? It's one thing you could say Uber owns the end consumer, at least today. But the supply side was actually a lot of the battle when you look at, between them and Lyft, it was like, can you get the drivers? And you got the drivers, you got the better network. Here, that's going to completely change. And I think, the end users are fickle. Like, do people download the Waymo app and use it? Absolutely. I think long term they're still going to suffer. Like, it's their market to lose. Maybe the market expands some, but I still think like it's just going to be the preferred way to travel, and they're either going to have to pony up, lose margin using someone else's technology, pony up for AV cars and try to compete that way. And Waymo's and everybody else, like their technology keeps getting cheaper. They're expanding to more markets. I think it's a matter of time. I don't know exactly when, but this is a stock that I don't like those headwinds. I'm going to stay away from. It's not necessarily cheap. It's not the most expensive stock. Maybe let's just take a quick peek there. So they're trading at 18 times forward EBITDA and 27 times forward PE, expected to grow about 18%. So those are not bad numbers for that kind of growth if you believe that. But I think you're just going to continue to have doubts about how they play the AV market, and I think it's their market to lose. So I don't know, Bruce. You were a buy. I don't know if you've changed your view here. I mean, going up 5% is not the worst of the world. Obviously, you would have done better going to the S&P. But what's your thoughts at this point?
Yeah, I mean, like I'm probably on the sidelines here. Like I wouldn't probably deploy capital just because I think the future is too it's too unclear to me to see how they'll be able to fight the existential threat of Tesla and Waymo and anybody else who's developing an autonomous vehicle. I do think that's the future. I do think Dara is an excellent CEO. He'll continue to make the best case, I think, for the company, developing a platform that, it's not only the ride platform. I think I use the ride platform far more than any of their other products, but I think Uber Eats, like as it compares to DoorDash, is also, one of the dominant brands in the market. And so I think that they do have some scale advantages and distribution advantages that are almost impossible to recreate, but you do have some of the biggest competitors in the world, namely Google and Tesla, that are, trying to do exactly that, which is take them head on. And so I just don't know if, they'll be able to withstand that type of pressure indefinitely. I do think though that that the impact of both Waymo and Tesla is several years away. Like they'll be able to continue to execute, flawlessly, really with great leadership for the next several years, and then at some point, there will be
noise, though. There will continue to be noise about it that I think
there'll be a lot of noise. Yeah, there'll be a lot of noise in the market, and also people will extrapolate what they see in like the San Francisco market or the Austin market, and they'll say it's just a matter of time before this happens in every market, and that's true. And so it really will, they'll go from being on the offensive in some ways in these markets to being on the defensive. And it's just a question mark for me, how they're able to execute that, because these are extremely difficult products to like create and scale. And I don't know if, they have the expertise. I think they've tried before in the past and they largely haven't, made as much headway as their competitors. So this isn't an execution game. This is like a technology risk, not an execution risk, and it's unclear to me if Dara or Uber has the ability to fight that adequately in the market.
Yeah, so sounds like sell to hold for both of us. And I would say, on the Eats side, I think they do have, the network of restaurants, that they have is going to be hard to rebuild. I'm more at risk on the ride hailing side. And it feels like as kind of the general leader here, like there's just only one way for your market share to go, which is generally down as these, new competitors continue to compete. So, well, that is a wrap for our 6 stocks. I think we did a great job. Hopefully we can keep this up. I think all of our performance lookbacks, we have outperformed the market pretty handedly here. So we'll give ourselves a high five and hopefully continue to keep up the good work. And with that, should we do our exit saying? Our exit motto: bulls make money,
Bears make money,
pigs they get slaughtered. Oink oink. We out.
say make money, money, make money, money, money.
Make money, money, make money, money, money.